Welcome to Discovery Watch with John Kaiser.
I'm Jim Goddard. John, welcome back to the show.
Good to be back, Jim.
Ivanhoe Mines, which made and owns one of the greatest copper discoveries in history, Kamoa-Kalua, was hammered this week after news that the Congo government passed a big tax increase for the mining sector last weekend. What's this all about?
Well, this is a shock for the mining industry that has operations in the Congo. The Congo hosts the world's richest copper and cobalt deposits, and in the case of cobalt, supplies just over half of the world's output annually. The mining industry has relied on a tax code created in 2002 to relaunch the mining sector after the Civil War that ran from 1996 until about then. And the tax code was designed to encourage foreign investment to come back, and in fact it did, and it's done really well, and mining is up and operating again in the Congo. But apart from the conflict mineral problem, which mainly involves what they call coltan, cobalt and Colombian, and tantalum from parts like the Kivu region, where artisanal workers extract this material from small-scale operations, often overseen by warlords, and therefore it's called a conflict mineral. There are two key controversy about Congo's mining industry. One is that the deals that were done when the foreign companies came back to acquire the projects that had been lost during the Civil War and that were within the government reserve, the acquisition of these projects often involved intermediaries who in turn had relations with government officials that involved corruption and that steered projects in this direction and that direction. Now, the troubles this week have nothing to do with that. This corruption stuff is being dealt with. It affects existing deposits. One could argue that Ivanhoe's Capucci high-grade zinc deposit is in that category, but this has come to Ivanhoe through a number of steps and is not really anything that was acquired through intermediaries that may have had corruption involved. Kamoa-Kakula is a special case because this was a deposit discovered by Ivanhoe with its team of professionals. It's a grassroots discovery. The company put in its risk capital, and it deserves to have the stake that it does have. So the controversy is whether the mining law from 2002 is fair for the people of Congo. And in 2015, after we saw the big price increases for cobalt and especially copper during the China super cycle, they decided to revisit the mining law and come up with something that they consider more fair for the country. However, this planned change was shelved because in 2015, metal markets were once again falling apart. The mining industry was on its heels, and it was decided it was not a good time to change the tax law. Now, this tax law, the proposals that they had, was to increase the tax rate from 30% to 35%, to increase the royalty from 2.5% to 3.5%, and to allow the government to take up to 10% rather than just a 5% free stake in any significant deposit that goes into production. Now, none of this is particularly consequential to Ivanhoe and its future plan to develop the Kamoa-Kakula deposit. It and its equal partner Zijin have already given a total 20% to the Congo government, so they're well above what the new law would require. And 2.5% to 3.5%, that's not a big deal. But one of the surprises in this proposed tax change was that if the government declares a metal a strategic substance, the NSR will be 10%, which is quite high. It's similar to the 10% royalty charged in Botswana for diamonds. But Kamoa-Kakula despite being the richest copper belt deposit ever found, has no cobalt content. So that's not a problem for Ivanhoe either. The stock dropped. It had already started sagging earlier this month from a high of $5 late last year. It was down to about $4, and it's now dropped as low as $3 because during the past week, the Congo government decided that it would put this legislation back on the table, on the agenda, and they passed it, and they included something that is truly bad for the mining industry. They included a windfall tax where if the metal price rises 25% above the base case price used in a feasibility study, there will be a 50% tax on that on the profits rather than just a 35%. Now, windfall profit taxes are okay for projects where there is little upfront capital cost, such as developing an oil field. So if oil suddenly goes from $50 a barrel to $100 a barrel, it's plausible. It can be considered fair that the government should participate in that profitability. But in the case of mining projects, they have substantial upfront capital costs, which need to be paid back with a return from a 10 to 20 year stream of cash flow. And the assumptions for metal prices, well, you know, who knows what copper prices are going to be 5, 10, 15 years from now. So there's a lot of risk that somewhere down the road when the mine is in operation, a global recession takes the copper price down, and these systems typically have no protections for the evaporation of the profit margin. But to propose a trigger where if the company gets lucky and metal prices are up for some reason for a few years, that the government can grab a substantially larger share, that is a deal killer for the mining industry. So this was a bad thing that the Congo Parliament included in this proposal. Now, the situation with Kamoa-Kakula, they did a PEA for the Kamoa portion, which was found first over a year ago, and they're working on a PEA right now for a combined Kamoa-Kakula operation. Kakula is an even higher grade version of Kamoa. PEA is still one of the first 3 steps in demonstrating feasibility. It still has 30 to 35% inaccuracy to it, and the next stage is a pre-feasibility study, which drops it down to 20-25%, and then ultimately there's the feasibility study on which a permit is based and on which a decision to proceed with development is made, and that drops it down to 10-15%. So whatever prices Ivanhoe uses later this year when it publishes its PEA, that would not be the basis for this future trigger. Now, this creates an interesting proposition because what prices are you supposed to use in an economic study to achieve those after-tax net present value and internal rate of return numbers that the financial backers use to make a decision? Now, a few years ago, companies were using trailing averages because back in the 90s and early part of the noughties, it was appropriate to smooth out the business cyclical changes in metal prices and just have some sort of average. But then after the super cycle run-up, these trailing averages were really, really high, so it became inappropriate to use trailing averages. So then do you use the spot price? But the spot price is dictated by all kinds of short-term fluctuations. So what price should you use? Now, the bias in something like this will be to use a very high base case price, a very optimistic base case price, in order to set the trigger very high for when a super windfall profit tax comes into play. So it's this whole idea of a windfall profit tax is a distortion in the whole decision-making process for investing an awful lot of money into a mining project. Now, the other thing that's a problem with Congo is Kabila has refused to step down at the end of his term. There have been no elections for a new president called. The country is unstable at the moment. There's also a tug of war between the China and the United States with regard to Africa's resources. And the United States has let this slip with the change in administration at the end of 2016 and Donald Trump's America First policy, an apparent giving up of all these issues outside the United States that they indirectly controlled. I mean, the United States has controlled Congo for ages, but with its withdrawal back into its own home base and seemingly abandoning the rest of the world, China is rushing into the vacuum. So the market's sell-off on Ivanhoe, it's not really justified. Oh, in addition, the other thing is that this legislation did is that it canceled this waiver the government had granted in the end of 2016 that all companies with serious operations would have a 10-year holiday. In other words, they would continue to pay taxes under the 2002 tax regime. That was flushed down the toilet, so everybody's taxes will be based on the new regime. Now, that was an additional thing that made the market unhappy. But I think the market is using this situation, even though it has no immediate consequences for Ivanhoe, to start playing the geopolitical card, the concern about how stable is Congo going to be, is resource nationalism going to completely destroy this the potential to mine these fabulously rich deposits in the Congo. So we may be seeing a backlash on the geopolitical front. As far as Zijin is concerned, that's a partly state-owned entity. It is a 39.5% equal partner with Ivanhoe. China's ultimate interest is security of supply. It's not really making profits. It's just making sure that their One Belt, One Road initiative becomes reality, that it becomes the biggest economy, and that it is secure from any of United States' attempts to push it around down the road. So there's this behind-the-scenes battle between China and the United States, and Congo is becoming the proxy for how that battle is unfolding.
We'll have more with John Kaiser right after the break.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead zinc silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan district of northwestern BC. Check us out at blindcreekresources.com.
Welcome back. We're speaking with John Kaiser. John, if Congo plans to bump the NSR for cobalt from 2.5% to 10%, how would this affect cobalt projects outside of Congo, such as the Sunrise Nickel Cobalt project of Robert Friedland's Cleantech?
Well, cobalt has been one of the metals where juniors with projects chasing after cobalt have done fairly well, and it's of course linked to lithium. Lithium juniors have also done very well, and you could see promoters and investors in these cobalt juniors doing a happy dance this week, because not only will this by adding a 10% surcharge onto cobalt coming out of the Congo, it makes the desirability or the profitability of mining cobalt in other jurisdictions so much better. Now, the problem for the cobalt sector is nowhere is the cobalt grade as rich as it is in the Congo, except in very narrow, high-grade systems that have no scalability. Consider in Congo, Katanga, which has also taken a hit in the past week. It is the largest producer of copper, cobalt in the Congo. It has 300 million tons of resources of about 3% copper and about 0.5% cobalt. In fact, its cobalt resources are staggering. They have 2 million tons of cobalt in the ground. That's about 15 to 20 years of current global supply. But if the Congo turns into another geopolitical mess, if the tax regime becomes really onerous, we could see the supply of cobalt out of Congo, even the potential expansion of supply, diminish. This should keep the cobalt price at $35 or higher for the long term. And of course, the big future additive users is the electric vehicle industry with the lithium-ion battery. Cobalt is an important component of the cathode, but the Congo, which makes people thrill about Congo because of the risk that it will explode, and it's seemingly everybody's friend, is also the enemy, because every end user is looking at this future cobalt supply squeeze. And so at the same time that German automakers are running around trying to nail down future cobalt supply at a fixed rate, everybody is also scrambling to find ways to reduce or even avoid any reliance on cobalt for at least the electric vehicle industry. And one way that's already underway is to use technological innovation to reduce how much cobalt you actually need in a lithium-ion battery. And then there are other much more radical approaches, such as the search for a magnesium-ion battery that actually works. And in a previous episode, we talked about a recently announced innovation where the key electrolyte problem with the magnesium-ion battery may have a solution in the form of a solid electrolyte that uses magnesium and either selenium or sulfur, and as the magic ingredient, indium, yttrium, or scandium. And if such a battery could end up being commercialized, well, then not only does the world have electric vehicle industry have no need for cobalt, but they have no need for lithium-ion batteries, because everybody wants to escape the problem of overheating and burning. That's a small risk, but when it happens, it's a catastrophic event. So, clean tech, surprisingly, didn't really move anywhere this week. It's still flattened at 140 to 150 range. But the market there may also be a bit disturbed by an announcement the company made, claiming that it has done a landmark agreement with Chinalco to research the commercialization of aluminum scandium alloy. And this struck me as one of the dumbest announcements made by anybody in the scandium space. Chinalco is a state-controlled entity of China that is the biggest aluminum producer in the world. They are aluminum. If there's any scandium produced in China, such as from the Bayan-Obo rare earth mine or from titanium dioxide waste stripping operations, Chinalco is there to buy it up. It is a giant operation. Its scientists know exactly what the scandium is good for when married with aluminum, and they have their own internal operations investigating other particular applications, because China's goal is ultimately to leapfrog the United States as a technological innovator. So this strange announcement that Cleantech's going to supply its engineers to help Chinalco, to quote them, to investigate the functional and commercial benefits of scandium is really a bit of a joke. It seems to amount to nothing more than what the CleanTech worked out with Airbus a few years ago when Airbus effectively gave Robert Friedland a slap on the back and said, go for it. And, whatever it is they did to go for it, nothing materialized out of that deal. In fact, CleanTech decided that scandium was such a tough nut to crack that it shifted its entire focus back to the original nickel-cobalt resource. And in the pre-feasibility study that they filed on CEDAR as part of its recent TSX listing, they don't even pretend to recover scandium as a byproduct from the nickel-cobalt operation, one that's going to cost $1 billion, and it doesn't even include key infrastructure costs that will be needed to move stuff like water to the operation. So the sudden announcement that we're teaming up with Chinalco was probably caused some heads to spin. People who are pricing the company based on the cobalt story are saying, what? Are we going back to scandium? And in fact, Chinalco is very interested in CleanTech because the Sunrise deposit in New South Wales is the world's biggest and richest scandium deposit. However, it is a ring around the nickel-cobalt resource. It is best mined as a standalone operation. But if CleanTech were to shift back to the scandium story and say, well, we're going to put this big giant nickel-cobalt thing on hold while we focus on developing the scandium project, the market will probably not take too kindly, because in terms of the initial scale of the Sunrise Scandium standalone, CleanTech stock price would probably be at 10 to 20 cents per share, with a valuation comparable to the Ningen project of Scandium International at the moment. So the cobalt news is not from Congo, is probably not really good news for the whole cobalt junior sector. Congo needs to be a stable baseload supplier of cobalt if the electric vehicle industry is going to continue to rely on the cobalt cathode as part of its lithium-ion battery configuration.
Closing comments from John Kaiser when Discovery Watch returns.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Welcome back. We're speaking with John Kaiser. John, how does the Chinalco backslap differ from the latest letter of intent published by Scandium International?
Well, I've noticed that in various stock forums there's been mocking of these letters of intents that Scandium International has published recently, 3 of them, which basically involve Scandium International's team collaborating with end users to supply aluminum scandium master alloy material so that the end users can play with this and change the alloy mixtures and so on for the types of applications that they are developing. A couple of weeks ago, it was providing this material for a company that has figured out a way to use rods to feed a 3D printer, which allows much greater, larger objects to be built efficiently than is possible with the powder provided by Airbus for 3D printing. So it kind of scales the market bigger. And then there was another news release with not a simple startup with a patent of a disruptive technology, but a company that's in the die casting arena, using aluminum copper-based alloys, wanting to play with scandium in it to enhance it for its purposes. And this was a private German company, and so Scandium International is collaborating to help them play with these mixtures and alloys to put that entity in position to take the supply if and when Ningen ever goes into production. But the latest announcement was a much bigger one, similar in vein in that SCY will provide sample material, but this time it's to a company called Gränges, which is a Sweden-based company. It has about $1.3 billion of revenue and about 1,600 employees. And what it specializes in is rolled aluminum products, in particular for what they call the brazed aluminum heat exchanger market. And that consists of two main sectors: the automotive sector, where things like radiators have heat exchangers, and then the HVAC, or heating, ventilation, and air conditioning stationary market. Now, this has always been placed on copper plate, but the new material that's replacing it is brazed aluminum plate, and it's the Series 3 involving manganese and aluminum. And now this company is playing with adding scandium to enhance this material, and they're not doing it because they don't believe scandium is going to become available. So these types of collaborations, mocked as not representing any beef because they are not concrete offtakes, they actually involve developing a future market for which Cleantech, with its Sunrise project, will eventually benefit, because as all these parties figure out the details of what is the best particular scandium-enhanced aluminum alloy for their applications, when Ningen is built and starts bringing supply on stream, they will be there for the offtake market. And these other companies that have these projects, they will be swinging in gear to provide additional supply and create the sort of corporate diversity, because nobody is really comfortable with, say, one company such as Scandium International having a supply monopoly on niobium, something that CBMM figured out in Brazil with its Araxá niobium deposit, when it was just this one absolutely giant deposit. The rest of the world did not want niobium for enhancing steel's strength. So a couple other projects had to come into existence, such as Niobec in Quebec, and the world became happy that in a pinch, if there's a problem in Brazil, there can still be supply coming from other parts of the world. So these Scandium International announcements, there's probably maybe 10 more of them coming. These are significant. The Chinalco announcement by Cleantech is nothing but a meaningless go for it backslap.
John, thank you so much for the update.
You're welcome, Jim.
We've been speaking with John Kaiser, his website, kaiserresearch.com. I'm Jim Goddard.
Comments made on Discovery Watch are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at howstreet.com. Discovery Watch is a production of How Street Media Incorporated.